I'll just have to come back. Okay.
So, hi, is that Noel?
Hi, yes, Julie, hi. So we are live now to the audience. The audience here at the ESG Investment Leaders Summit. Thank you very much for joining us here. I'm joined by Julie Moret of Northern Trust Asset Management, who's going to be giving us her views on how ESG is impacting portfolio construction. I know Julie has some notes for us to be going over today. So I believe Julie's going to be able to talk us through some of the key points that we do have. Julie, would you like me to share that the screen with the PowerPoint, or would you like to kick off a bit to discuss the points that we have there?
Well, I think we were having difficulties in sharing the presentation, so I actually have the presentation loaded. Can I just check, though, yourself and the audience, are you seeing the full presentation as I move through?
We see it just now, yep, so we can see it on the screen. I think I think the PowerPoint needs to maybe be switched on the bottom right, and that will then be able to share it in full. But if not, I think we can see it just here. And what I can do is put it onto the main screen in this regard, Julie, and then we will be able to see it in a slightly different way.
Okay. Well, would you like to go ahead and do that, and then we can kick off?
Yeah, I'll do that just now. Yeah.
Okay. Noel, perhaps whilst you're doing that, if you could just give me a cue when we are ready to start, because I'm presenting this from a laptop. So I only have the one screen, and at the moment I just see my presentation slides.
So that is ready. So you can see your presentation slides now with the session agenda. So if you want to kick off from there, we'll be able to see the screen here.
So do you want me to stop sharing?
If you keep sharing as it is, and then if you want to go through the slides there, that would be fine. Yeah.
Okay, great. Well, I'm delighted to be here. I believe we've got the next 30 minutes or so together. I'm Julie Moret. I'm the Global Head of Sustainable Investing and Stewardship at Northern Trust Asset Management. I oversee our sustainable investment practice, which is made up of three core components. Number one is ESG research and integration, and so working across our investment groups to deepen and evolve the application of ESG into the investment processes. Secondly, through our client engagement, the design of what we call sustainability targeted driven strategy. And the third pillar of our practice is our stewardship function and how we engage with the corporates on ESG issues and how we vote our proxies. So the sustainable investment practice, as of today, is just shy of $170 billion in dedicated sustainable investment mandates. What I wanted to take the audience through today is a little bit of a sneak peek at some findings from our ESG Risk Report, which is what we're going to go through over the next 25 or so minutes. And so the ESG Risk Report is essentially a mixture of market trends analysis and actual portfolio analysis. So what we've done is we've analyzed in excess of 250 plus equity portfolios that span 1,500 plus strategies. And this is over 75 institutional investor types. And you see the demographics there up on the screen in terms of the makeup of who are the types of institutional investor portfolios we've been analyzing. So the analysis covers a 4-year period. I'll be very quick to add, though, that we've been conducting this type of analysis in well excess of a decade. It's a service that we provide to our clients who really want to have a deeper dive into understanding what are the implications and impact of introducing ESG content into their portfolio. It is a holdings-based analysis, which is a point in time. We're using the BARA risk models to calculate ex ante risk, and we're using MSCI's ESG and carbon data sets to measure the ESG content in the portfolios. And so with that, let's dig into some of the findings from the report, especially in terms of what does the current market landscape look like in terms of ESG adoption across portfolios. And so here on the first slide, what we see by client type, what are the portfolio ESG scores relative to the benchmark. Now, by and large, across most of our client types, what we're seeing is that the portfolio's ESG score relative to the index is lagging. By that, what I mean is that the average ESG profile of portfolios is below that of the index. Now, what is happening here is that we have observed over the last several years that there has been a
Julie, I'm sorry, I need to interrupt for a second. You haven't clicked onto the next slide. We can see that you're still clicked on the session agenda PowerPoint presentation.
Yeah, so then I think we may have a technical complication because I'm moving through to the slide, and on my laptop, it's showing the next slide, which is investors are losing ground on the broader market.
I do apologise to our audience then. We do seem to have an unknown technical issue. Julie, if you may just continue then, just explaining your points. Unfortunately, we're not able to actually see that slide itself. But if you may just continue just to explain those key points, then I think for the audience that could still be extremely beneficial for us. Okay, so I'm happy to do that, Noel. Is there any way though that I can give you control of the slides that you can run through if there's a complication on my side? Yes, it would be difficult because we don't have the PowerPoint presentation here, but if you give me a second, if you want to continue, I'll bring that up and then we'll look to share it from our side. So if you'd like to continue just for now, then Julie just explaining, and then we'll bring that across very shortly. Okay. So whilst we get the technical issues sorted, I'm gonna re-reference. Let's try this again. Okay, so really just to level set in terms of what we're seeing in terms of ESG adoption in portfolios. From those 250 plus portfolios and 1,500 strategies, when we looked at the ESG profile, and by and large, across all the investor types that we were looking at, we've been observing that the average portfolio ESG scores have been lagging that of the benchmark, which is to say that the portfolio's ESG score is lower than that of the benchmark. Now, the reason that we believe is happening here is that over the last several years, the ESG content within benchmarks and indices have persistently been increasing over time. And so even though your own portfolio's absolute ESG scores have been improving over time relative to the index, there is in essence a larger bridge to gap because that improvement of ESG content within index and benchmark indices is much more substantive and larger. And so unless you're fully invested in the index, it becomes quite challenging to bridge that gap. Now, there's actually two reasons that is driving that persistent increase in ESG content exposure within benchmarks. And those two reasons are, number one, generally over the last several years, we've observed companies' ESG practices as well as disclosures have been improving around sustainability and ESG metrics. Now, certainly there's variability across the markets, and so typically we tend to find European companies have higher disclosures than in other markets, say, for instance, emerging markets or Asia Pacific. Secondly, as well, this is really a result of investor-led initiatives such as the Task Force for Climate-Related Financial Disclosure and the Sustainability Accounting Standards Board, who have been advocating for the last several years around disclosure on measurable, comparable, and consistent sustainability metrics. We believe the next game changer in the marketplace that investors should be paying attention to
is the creation of the International Sustainability Standards Board, which will continue, in our view, to really push that focus around disclosure around materiality-based sustainability metrics. So that's one kind of key takeaway, is that we do observe that ESG adoption at the aggregate portfolio levels continues to lag that of the benchmark. Now, the second interesting feature is when we actually disaggregate some of the ESG.
Julie, we have your presentation up. We can see it. It's in full screen, so everyone can see it on the current landscape. If you'd like to guide me through to tell me the page you'd like me to go to, then I'll make sure our audience can see that.
Okay, so let's have a look. If you could flip through to, I think, slide 3.
Yeah. That's the slide on the session agenda, and then the slide afterwards is the ESG Risk Report.
Yes.
Perfect. Yeah. And then we have the current landscape, and then investors are losing ground on the broader market.
Okay, brilliant. Thank you, Noel.
Okay. And please do just let me know when you want me to move on. Thank you.
Yeah, I will do. Thank you. So just in terms of a second key takeaway, and hopefully the audience can see enough of the slides, but again, just to underscore, this presentation deck is available for download. And so when we look at disaggregating some of the ESG scores into particular components, and in this instance, we're looking at carbon intensity measures, what we actually see is a stronger picture and a better picture with regards to the average carbon exposures in portfolios relative to the index. Now, by and large, across investors over this 4-year time period, we're seeing a lower portfolio CO2 carbon exposure score relative to the index. Now, in this instance, lower is better. What this is capturing is carbon intensity within the portfolio as measured by scope 1, 2, and 3 relative to the index. And what this is saying is that by and large, most portfolios that we've analyzed across most of those client types have had a lower carbon footprint, carbon intensity than that of the benchmark. A couple of interesting outliers there, right? So superannuation funds, there's a heavy tilt there to markets such as Australia. And because of the high concentration within the Australian marketplace in extractives, which generally has a higher carbon intensity, that's what we're seeing play out here, that on average, you've got portfolios in the superannuation funds that have a higher CO2 carbon intensity measure than the benchmark. I think, again, what I would say is not altogether unsurprising when we look at really the impact on initiatives such as Climate Action 100+, or the Net Zero Asset Management Alliance. What the results from our empirical study is finding is actually in support that a lot of these investor-led decarbonization initiatives are having the impact as intended, which is to really continue to decarbonize the carbon intensity and footprint within the portfolio. Now, if we move to the next slide, Noel, and actually just look broadly speaking over the last 5-year period as to what we're seeing with ESG scores, aggregate ESG scores across the portfolio. A couple of interesting observations materializes. Number one, not again altogether unsurprising that we see a persistent positive exposure to corporate governance factors. And so corporate governance factors in this analysis captures indicators such as board composition, board structure, remuneration of management. So really those indicators that capture how well run a business is. And so over the analysis period that we have from 2017 to 2021, we see this persistent positive exposure to corporate governance. What that's picking up is generally there is a higher signal to noise ratio between corporate governance indicators and financial performance. What we're seeing on the S pillar is that in the most recent past, we're seeing a positive tilt in portfolios towards social factors, particularly around human capital and specific to diversity, equity, and inclusion. We think some of what we're seeing here is really a play out of the increased pivoting over the last 12 to 18 months around human capital issues. Now, what may seem surprising on the surface is what is a monotonic downward trend on the environmental pillar, particularly in light of this focus on decarbonization and reducing carbon intensity. And that in itself is the reason why we're seeing this downward negative exposure on the environmental pillar. The focus has really been primarily on carbon reduction and decarbonization. If we move to the next slide, MSCI, as measured by MSCI's methodology, the environmental pillar captures not just decarbonization and carbon reduction, it's capturing elements of waste, water management, natural resource use, and financing of environmental opportunities. And if you look from the bar charts in front of you, again, you'll see that by and large, there's actually over the time analysis a negative exposure to each of these sub-pillars underneath the environmental theme. One way to think about the result there is, because of this almost singular focus that we've been seeing of late on cutting carbon emissions and decarbonization, what the analysis is drawing out is that there isn't that weight of emphasis on future forward solutions around managing environmental externalities. Now, the one thing I do want to point out to the audience is this weighting and this focus on carbon intensity measures. What is going to be really important to keep your eye on is what happens within Europe with the EU taxonomy and EU disclosure regulations around climate, because the next stage of that regulation is going to be looking at circular economy, water, waste management, essentially natural capital and biodiversity issues. And so what will be interesting to pay attention to is in client investor portfolios over the next several years, just to see whether some of that weighting and tilting towards more broader biodiversity and natural capital solutions we see will come more into play within portfolios. Now, the beauty with this type of analysis, and if we move to the next slide, Noel, the beauty with this type of analysis is we can decompose all of these ESG information into even more granular components to really understand what's going on underneath that environmental pillar. Now, I apologize if what you're seeing up on screen is too small to read, but again, the presentation slides are available for you. But I do want to draw out a couple of insights from this slide. And so what this slide does is it decomposes even further within each of these pillars, such as water, waste management, the components that go into making up a particular environmental pillar. And what we're seeing actually at this level is there's a valuation story at play as well, because over the 4-5 year analysis period, we're seeing a negative exposure to a number of these environmental considerations. Now, when we dig into the data a little bit more, what we've observed is that some of the industries that make up the environmental subpillar, particularly around renewables and solar, we're seeing companies in those industries trading at near-time high valuation multiples. For some companies, in excess of 20 or 30 times multiple. And so naturally, as valuations creep up, as investors, you don't necessarily want to be plowing into or exposed to increasingly expensive segments of the marketplace. And so some of what we're seeing, we believe, with the negative tilt and the negative exposure on some of these subcomponents in client portfolios is really a reflection of the high valuation multiples that we're seeing. And so, if I had to summarize these first early slides, I would say that the key takeaway really from these slides is that as investors begin to think more deeply around the implementation and the introduction of more ESG content into their portfolio and what that means for the risk profile of the portfolio, one has to be very specific around understanding that intersection between ESG factors, ESG content, along with valuations, as well as with the risk budget and the risk profile of the portfolio, particularly because introducing ESG content alone can introduce some unintended biases within portfolios, which is what we'll get into in the next couple of minutes. Noel, if you could kindly move on to the following slide from here. So in the next slide that's coming up, and there may, okay, great. So there seems to be a timeline. So, another couple of interesting features that we found when we decomposed the various portfolio risk profiles in our universe was that actually there's a large proportion of the risk decomposition of portfolios that are being attributed to uncompensated risk factors. And so when we looked at the specific ESG targeted driven strategies, what we found is that when those ESG strategies were aggregated at the total portfolio level, there was a dilution of active risk of up to 50%. And when we decomposed the actual active risk profile of these portfolios, what we found is that by and large, almost 50%, in fact, of the risk concentrations in the portfolios are due to uncompensated risk factors. And so the question is, as portfolios are being constructed with these very intentional ESG targets and bets, how does that ESG concentration or tilt play out when those portfolios are combined at the total portfolio level? And what we're finding is that a large part of the ESG content is being diluted away through offsetting positions. And in fact, at the aggregate level, we're introducing unintended biases, particularly where the allocation of risk is coming from these uncompensated risk sources. If we move forward to the next slide after that, let's dig into some of those hidden risks within the portfolio. So there's really two features here that's worth calling out to the audience. Number one, as I touched on earlier, what we're seeing is a wider dispersion in valuation, particularly in portfolios of high ESG rated securities. So if we were to build a portfolio of a top rated ESG, a portfolio comprised of a basket of top ESG rated securities, and we measured the performance and the risk relative to the broad market index, what we found over the most recent years is a widening dispersion in valuations. And so the active risk of a basket of securities which are high ESG rated, the active risk of that basket of securities has increased by almost twofold from 2020 versus a couple of years ago, even in 2018. Now put another way, an investor, that's what that is saying, is that an investor for the same ESG content in their portfolio is paying twice as much for risk. And some of the risks that some of the ESG content introduces are inherent biases towards certain style exposures and certain sector exposures. And so really, again, what we've observed from analyzing these portfolios is that as one looks to introduce ESG content into the portfolio, it really becomes critical to think very deeply around efficient portfolio construction to ensure that the risk concentrations within the portfolio are actually an intended part of that strategy, that they have the potential to be rewarded, compensated, and that they're clearly understood, because some of what we can see with the valuation dispersions is introducing some unintended style and sector biases. Now, on the style basis, if we go to the next slide, we also took a look at what is the relationship between ESG factors and compensated style factors. And so what we mean by compensated style factors is those factors such as value, growth, momentum, dividend yields, that empirical evidence and research have identified are actually associated with an alpha signal as well. What we see on the screen in front of us is a 3-year rolling correlation on ESG factors, how the relationship between ESG factors and high ESG rated factors relative to these compensated style factors. The interesting takeaway from this slide is you can see that prior to 2019, there's been quite a muted relationship between ESG and traditional compensated style factors, which meant that one could construct a portfolio with a high degree of ESG tilt, a high degree of ESG content without necessarily bringing in any significant style risk exposure. Now that relationship from late 2019 until present day has really changed. You can see this widening dispersion between ESG and some of the style factors. If we take, for instance, momentum, largely that's attributed to the high price momentum that we've seen as capital has plowed into companies in renewables or solar. We've seen heightened valuation multiples in some of those industries. The negative correlation that we see with value is really a reflection that value portfolios tend to be tilted towards defensive sectors such as energy, utilities, and mining, which tend to, from an ESG risk perspective, have high ESG risk impact. And so again, the takeaway there is, as one looks to introduce ESG tilts within the portfolio, to really have a keen understanding of what are some of these changing relationships, correlations between more traditional compensated style factors, and how to introduce portfolio construction techniques in really creating efficient portfolios that are tilted towards the characteristics that you intend on the ESG whilst remaining style or industry neutral. Now, I know that we're coming up to the end of our session, and we've eaten a couple of minutes in because of some of the technical hurdles. So what I'd like to do in the last remaining minute, Noel, is to go to the next two slides in advance and really land on the key conclusions there. And so what the analysis has really done is, what we're trying to solve for is what happens when you introduce ESG content into portfolios. And by and large, what we're seeing is that, there is not just overall unintentional biases around styles or industries, but as you look to combine your ESG managers with your other managers within a total aggregate equity portfolio, we're seeing that through these offsetting positions that the ESG content can be diluted away, which brings into question that we believe the sleeved approach to ESG integration is becoming less effective, but also the more managers that you include into the mix, which is true for any risk diversification, you begin to dilute away some of that ESG content. And so if we land on the last slide, the real key takeaways there is all of these issues are actually very clear and achievable to address. And so, whilst integrating ESG into portfolios really heightens the focus on portfolio construction to mitigate some of these unintentional biases, and over diversification can hurt. Performing this type of in-depth portfolio diagnostic, as we do for clients, really allows us to pinpoint where are the hotspots in the portfolios that we can address to mitigate and minimize some of the risks, so that ESG content remains preserved. So with that, Noel, I know that we literally have a couple of minutes before the next session, but I'm gonna end it there. And if we do have time and there are questions, I'm happy to take a couple of questions before you need to move to the next session. Oh, no, I can't hear you.
We certainly will be putting these questions to you, but unfortunately we have to conclude just. Please do click on back to timeline and then into the next session, and we'll join you there. But Julie, thank you very much for your time.
Great. Thank you, Noel. Thank you.